I see. Okay, so we have a couple of people here. All right, why don't we wait a minute for everyone else to show up and then we'll get started because this week we're doing option pricing models, which is a very complicated topic. So, we'll just wait one more or two more minutes and we'll get started. All right, we don't want anyone to miss this, that's for sure.
Professor,
Yes.
can I have a question? Are you receiving my email, the assignments?
Oh,
I want to make sure that.
possibly. No, I haven't had time to go through them yet, but I will. Don't worry, very soon, because I've been correcting midterms like for the last 2 weeks in a row from undergraduates. So in another day or two, I'll have time to sit down and start going through them all. So yeah, no, I'm sure I have them. I just haven't had time to look at them yet. Sorry about that.
No, thank you very much. Yeah, every time, I mean, after the class, I send the email, but I just want to make sure you are receiving my email at least. So,
right.
Yeah.
No, it should be fine.
Thank you.
That's what the holdup is. It's just that I've been like swamped with all these, undergraduate exams. So, and then we had the holidays and all this and that. And then, so, yeah, probably this weekend, I'll catch up with all of them.
Thank you very much. And if you could share with us the syllabus when it's ready.
Yeah, that's right. You know what? I have a syllabus. You know what the thing is? I have a perfectly good syllabus, but all of a sudden at the last minute, they changed the whole formatting. And, it's really not a simple fix. It's just a very, very, very different from what I had given out in the past. So, I was going to get it done. And so I was just very annoyed that I couldn't just use the last one. But,
okay, thank you.
It's the same thing. I'll get it done this weekend.
Thank you. Yeah, I just want to know if there are any exam at the end of the semester.
No. It's just the assignments.
Oh, okay, got it. That'd be nice to know. Thank you.
Yeah, that's all there is. It's just the Excel assignments, and that's all you have to do.
Okay, good. So class attendance and the assignments after the class. Right. That's all.
Yes.
Yeah, thank you.
Okay. All right. Anyway, so it looks like we might as well get started here. So, all right, let me get everything open. Week 5. Now it says properties of stock options, but I mean, we're basically going to be doing some theory basically about how options are priced in the market. And it's a fairly complicated topic. So we want to take it easy. So why don't we start here? Now, first, what are we doing here? First, we need to understand the factors that determine the value of an option. See how they're bounded within specific ranges, understand the concept of arbitrage, which we've been talking about, but they're especially important with options. And then finally, we're going to look at something called put-call parity, which is basically it's a relationship in option pricing theory that shows us how the price of a European call option is related to a European put option. So we'll start at the beginning, the factors that influence the price of a stock option. Basically, the following features are necessary for us to properly understand how much an option is worth in the marketplace. Whatever asset the option is written on, of course, we need to know its price, but we also need to know the strike price of the option. And we did look, I think last week we were looking at some actual options. Let me go get that page back open again so we can look at this for a second. Under this website, finance.yahoo.com, I believe we were looking at options on Apple stock. And so look at options. And down here, if you notice, we have the calls listed up here. And we have the puts down here. And the maturity date is listed here, although we have many others to choose from. And they also show us the strike price. But there's a couple other things that are not listed here. But here, yes, the price of the asset, which in this case would be the Apple stock, it's 160.24. The strike price, which is the price at which you can buy the stock if you're owning, if you're the owner of the call, or at which you can sell the stock if you're the owner of the put. That's what that is. So that's an important detail. And in fact, if you look at this very carefully with the calls, you'll notice that the strike is here, the ask price, which is what you and I will pay for this option. When I increase the strike price, the ask price is actually going down. Because as the strike price rises, that makes it progressively harder for us to make money with this call option. Because remember what's going to happen. You have the right to buy the stock at, in this case, $100. But look at this, the stock is selling for $160.24. So that means this option is worth a minimum of $60.24. It's actually selling for slightly more than that, $61.05, and we'll see why later on. But if the strike is 105, that means the price of the option has to be at least $55.24, and it's actually 56. And then as you keep scrolling down the list, for example, at 120, this option has to be worth a minimum of $40.24, and it's actually selling at $40.75. So as you keep rising or increasing the strike price for a call, the value of the option goes down. Look at this one. At 160, the option is only worth $2.08. And then now down here, the options are out of the money. So here, the strike price is 170, which means the option will be worthless unless the stock price goes to at least 170. And so because of that, the option is only worth 8 cents. It's a very small price because there's a very low chance that this actually could happen between now and December the 3rd, which is, I think that's Friday. So in other words, if you buy that option, you're saying, listen, I'm hoping that the stock price will go up to at least 170 by Friday. And if I'm wrong, I only lose 8 cents. So sometimes it's nice to, you know, some speculators like to gamble on these out of the money options. Because if they're right, the rate of return can be enormous. But of course, if they're wrong, they just lose their investment. So, and then down here, the puts, this works in reverse. A low strike is actually bad for a put because that's the price at which you can sell the stock. So nobody would want to sell the Apple stock for $100 when the stock is worth 160.24. So these puts are all what we call out of the money. Right now, if they expired today, they would have no value. We have to go all the way down here to 162.50 before we find the first put that actually has a positive value. In fact, at 162.50, if we were to execute that put, we'd have a payoff of $2.26. So the option sells for a little bit more than that, $3.40. So here, as the strike price rises, you can see that the value of the put goes up. Like here, oh, look at this one. This one gives us the right to sell it for $210, but it's only worth $160.24. So that means that option is worth almost $50. I mean, the minimum price is at least, and so it's selling for $50.50. So the strike price is a huge determinant of the value of either a call or a put, although it works in opposite directions for the two. And of course, this number, now we can't show you that unless this changes while we're watching it. If the stock price goes up, all of these calls, the prices of all of these calls will go up, whether they're in the money or not, because they're more valuable to the owner of the call. Because remember, you have the right to buy it at a fixed strike price. If the stock price in the market goes up, that's more advantageous to the call owner. But on the other hand, if the price went up, all these puts would all go down. Because remember, the put is the one that lets you sell the stock, and you don't want the price to go up. That reduces the value of your put. Okay, the time to maturity. Now, all other things being equal, the more time you have until the option matures or expires, the more valuable it will be. So why don't we pick as an example, let's say the 150 strike call. Here, the one that expires on December the 3rd is selling for $10.90. So let's just remember that. Let's go look at one that expires, let's say in January. Oh, what happened here? Here it is. Instead of 1090, it's worth 1330. Okay, it's the same strike price, it's the same stock. It's just that there's more time now between the maturity date today and the maturity date. The first option I showed you expires on Friday. This one has about a month to go. And so because of that, there's a greater chance that the price of the stock will go up and make this option worth even more than it is now. So that's why the time to maturity has a positive impact on the price of an option, because it increases the likelihood that the stock price will move in a direction that will provide you with more money. And as it turns out, the same thing is true with the puts, but for the opposite reason. There's a greater chance with the longer maturity option, a put that is, that the price will go down too. Okay, so in other words, it cuts both ways. The longer the time until the maturity date, the higher the probability that the stock price will go up, but also the higher is the probability that it will go down. So therefore, that adds value to both calls and puts. So they both benefit from having a longer maturity date. What about these? Now, volatility, we briefly discussed this. What is volatility? Well, volatility refers to how much the stock price changes over time. Let me just show you a couple of examples here with some graphs. Suppose we had these two stocks, and you know that some stocks, the price fluctuates a lot, and other stocks not so much. So let's say we have two stocks. And let's just say that this is the stock price and this is the time. Here's stock one, we'll call it, or stock A, let's say. And here's stock B. Well, it doesn't change too much. We just call this a low volatility stock. And look at this one. It's all over the place. This is a high volatility stock. So it turns out that higher volatility is actually good for an option. So higher volatility increases the value of both calls and puts. Now, why is that? Mainly, here's the reason why this is happening. The low volatility stock doesn't change much. If this option, let's say an option is written on stock A, and it's currently out of the money. Okay, let's just say that, for example, make up some numbers here. Suppose that a call on stock A has a strike price of 100 and matures in 1 month. The stock is currently selling for $90. Now, this stock hardly ever changes. So you can see, I mean, it just sits there. So the probability that this option will be in the money, which means a positive payout, by the way, in 1 month is very low. Therefore, the value of the option is low. On the other hand, what about this one? Let's just say that we have a similar option on stock B, except this time everything's the same. Strike of 100, matures in a month, selling for 90. The probability this option will be in the money in a month is very high. or I should say much higher than for stock A. Therefore, the value of stock A, the option on stock B is greater than the value of the option on stock A. Does that make sense? In other words, because stock B bounces around so much, the chances of it suddenly surging into the money, moving up and suddenly moving up above $100 is much greater than for stock A. Now, what I'm going to do is point out, now this is an important detail. If these options are already in the money, stock A is less likely to finish out of them. I shouldn't say stock A, the option on stock A is less likely to finish out of the money than the option on stock B. So you might think that that gives A the advantage, but once an option is out of the money, its value is zero. End of story. If an option is in the money, its value can increase dramatically. So therefore, on balance, the option that is more likely to end up in the money because it's written on a volatile stock is going to be worth more than the one that's very, very stable. And well, it's true that once it's in the money, it'll probably stay there. The one that's very volatile is more likely to finish out of the money. But if it does finish in the money, the payoff could be quite large. Okay. So anyway, so this is sort of like an intuitive look at why higher volatility is better, all other things being equal. Okay. All right, hold on one second. I was trying to print something before we got started, and I ran out of paper, of course, and now the printer is being very upset with me. So if you could excuse me for 1 second, I'm going to add paper to my printer. It's just every 5 minutes, it's making a lot of weird noises. So I will be back in 1 second. Oh. All right, it's happy again. All right, so I don't know how much sense that made to you, but the bottom line is that volatility is positive, has a positive value for both calls and puts. All right, so that's what we're aiming for. Now, also two other things will affect the value of an option on a stock: the risk-free rate of interest and the dividends, if any, they're expected during the lifetime of an option. Now, you might not think that the interest rate would really matter, but it really does. Let me show you why. An increase in the rate of interest benefits a call option, but hurts a put option. So interest rates going up are good for calls, bad for puts. The question is why? All right, well, let's think about this for a minute. What is actually happening with a call option? Suppose that a manufacturer needs to buy gold in 6 months. in order to avoid price risk. Manufacturer buys a call option on gold for delivery with a maturity of 6 months. Okay, now this has the advantage, or actually, let's put it this way. The alternative would have been to borrow money, buy the gold today, and store it until it is needed in 6 months. Because remember, we're manufacturing something with gold. We don't need it for 6 months. So what do we do to avoid the price risk? We can either buy a call option on the gold, which prevents the price from going up. The other alternative would have been to borrow money today, buy the gold now, and store it until it is needed in 6 months. Now, what problem does that introduce, though? So the call option is actually saving the manufacturer from paying interest on this loan. All right, I'll call it, the call is saving the manufacturer interest on a loan that is not necessary because the call can be used to lock in a price, the gold, instead of borrowing and buying the gold. Therefore, the higher is the rate of interest, the more the call option saves the manufacturer in interest costs or borrowing costs. Does that make sense? Okay, good. Now, what about the put, though? Why is the put not benefiting from this? Okay, suppose that an exporter expects to sell, let's again use gold, in 6 months. And is worried about price risk. So suppose the exporter buys a put to sell the gold in 6 months. Okay, now, alternatively, the exporter could store the gold for 6 months and deliver it at that time. Now, here's the problem with the second strategy. This means that the exporter is giving up the opportunity to invest the value of the gold and earn, let's say, interest. So in other words, whatever the value of the gold is, imagine you're sitting on all this gold and you're sitting on it for 6 months waiting to sell it. And so by having it in your possession, you don't have to worry about price risk so much, but you're losing the opportunity to sell that gold and invest the proceeds by putting it in a bank account, let's say, which is what you could do if you had a put option. Okay, in other words, if you bought a put, you can now sell any gold you already have, and you can use the proceeds to invest, and then you can sell it. You could sell whatever gold. Now, remember, we're assuming that you're producing the gold. So in 6 months, you expect to have gold to sell. which means that any gold you have now, you can sell it and invest it, and then deliver whatever gold you produce in 6 months through the put option. So anyway, the bottom line is with the put, you're sacrificing the opportunity to earn interest on the gold that you're sitting on. All right, so in other words, there's an opportunity cost there. And so the owner of the put is basically delaying the opportunity to sell the gold and earn interest on the proceeds. Therefore, the higher is the rate of interest, the more of it disadvantageous this arrangement is. So in other words, when interest rates go up, having a put is more disadvantageous than when rates are low. So in other words, interest rates are impacting calls positively and puts negatively. Now, having said that, if you look at all the factors that affect the price of an option, probably the interest rate is one of the less important factors. Certainly it's nowhere near as important as volatility. That may be the most important determinant of the value of the option. The interest rate has a lesser impact on the price of the option, but we can't just ignore it either. And then finally, the present value of the dividends during the lifetime of the option. Now, why is this relevant? Well, here's why. When a dividend is declared on a stock, price drops by the size of the dividend. This is normally the case because otherwise there'd be an arbitrage opportunity. Like, how would that work? Let's see, how would that work? So in other words, imagine that you own a share of, I don't know, IBM, let's say. Which sells for $100. And IBM declares a $2 dividend. The price will immediately fall to $98. What would happen if this did not happen, if the price did not fall by the full $2? All right, well, here's what you could do. Let's see, so you see that IBM is about to declare a dividend. So what you could do the investor could short sell the IBM stock for $100 a share. Okay. When this happens, the short seller is responsible for paying the dividend to the owner of the stock. So let's see. Oh, you know what? This is the case where it falls too much. I just realized, all right, how about this? What would happen if the price fell by more? Let's try that as our first example. And then we'll consider what happens if it falls by less. So short sell the stock, okay. Collect. Now, the price, the dividend is declared, and the price falls to 97. Now, with a short sale, that means the investor can now repurchase the stock for $97 and pay the $2 dividend to the owner of the stock for a cash outflow of 99. But of course, he collected $100 when he short sold the stock. So in fact, that's what happens with a short sale. You're actually collecting the value that you sell it at, and you're hoping to buy it back later on at a lower price. The cash inflow is the $100 that the investor received when short selling the stock. His profit is his risk-free arbitrage profit is $1. So that's the case if the price goes down too much. What about the case when it doesn't go down enough? Well, let's find out. Oh, first I have to do one thing here. Okay, so suppose instead the price only drops by $1. So an investor could buy the stock let's see, they'd buy the stock and collect the dividend. Yeah, at 100. Collect the $2 dividend. And then sell the stock for $99. Okay, in other words, we're saying that the price after $2 dividend, the price only drops by $1 to 99 instead of the proper 98. So I could buy the stock for 100, then the dividend is declared, I collect the $2 dividend and sell it at the new lower price of 99. This means that the risk-free arbitrage profit is, I pay 100. Well, actually, I collect 100 when I sell the stock. I paid 100, but I also collected a $2 dividend. So I made $1. Okay, so in other words, you see what happens. I suffered a capital loss on the stock itself. I bought it at 100 and I sold it for 99. But I did collect a $2 dividend. And so I made an arbitrage profit of $1. And if I want to, I can actually borrow the money to do this. I don't even have to take it out of my own pocket. And because it's a very short-term transaction, the interest that I pay is very, very trivial. So it might reduce my profit by a tiny bit, but not that much. So what this shows is that either way, while both of these strategies provided profits, both would have broken even if the price fell to exactly $98. So therefore, there would be no arbitrage opportunities. So therefore, this is why this happens. It goes down by precisely $2 if there's a $2 dividend, because if it doesn't, there will be an arbitrage opportunity. If it goes down too much, there will be an arbitrage opportunity. If it doesn't go down enough, there'll be an arbitrage opportunity. So therefore, it goes down by precisely the size of the dividend. Now, that doesn't mean the stock can't go to a different price tomorrow. But once the dividend is declared, the price will fall by precisely $2 to avoid an arbitrage. In an efficient market, you would not expect to see arbitrage opportunities. So what does this have to do with options? Okay, well, here's the point of all this. Anything that reduces the value of the stock or a stock, such as a dividend being declared, will reduce the value of a call option while increasing the value of a put option. This is always true. It doesn't matter why the price went up or why it went down. If the price went up, that helps the call and hurts the put. If the price goes down, it hurts the call and helps the put. So that's why the dividends that a stock pays have a direct impact on the value of any options written on that stock. So anyway, there's a table here that summarizes all of this. Now, by the way, I just want to point out, only in one case, which we'll address later on, is the factor dependent on whether this is a European or an American option. It just so happens, and we'll see again later on, that when time is involved, with a European call or put, there's a possibility that more time can actually reduce their value, but these are very unusual cases. But they're not impossible. They can happen. With an American call or put, more time always means a more valuable option. So that's what these pluses and minuses are for. For example, here, if the stock price goes up, the call written on it goes up, whether it's American or European, and the put value goes down, again, whether it's American or European. The strike goes in the opposite direction. A higher strike is bad for the call, as we saw with the Apple stock, but good for the put, again, regardless of whether it's American or European. Time always helps an American call or put, but under some strange conditions, it can actually be harmful to a European call or put. Volatility helps all puts across the board. And as we've already discussed, a higher rate of interest is helpful to a call, whether it's a European or American one, and it is harmful to a put. And finally, we've seen that a dividend, because it reduces the value of the stock, is going to reduce the value of any call, but increase the value of any put. Okay, so the table is basically summarizing everything we just did. So, but what you want to do is not just memorize this chart or anything, but try to truly understand why this is happening. Why is this happening? Obviously, the more valuable the stock is, the more valuable a call will be, and the less valuable a put. Okay, and these are always opposites from each other. These are the interesting ones. We've already seen, though, the volatility has to have a positive impact on the price of an option, whether it's American or European, it doesn't matter. Okay, so all of these hopefully make sense now that we've seen some examples. And so anyway, those are the factors that determine the value of an option. Now, the next thing we want to consider is there a maximum or minimum value that an option can have? And the answer is typically yes. There's usually upper and lower bounds for how much an option can sell for in the marketplace. But how does that work? Now, here we're going to see many different relationships that are enforced by this no arbitrage principle. In other words, if these relationships are violated, investors could come in and earn risk-free profits, and that would continue until the relationships hold again. So, for example, let me skip ahead a little bit because we've already basically discussed this. Actually, I did want to show you one graph that I put together that helps us maybe understand just a little bit better why volatility helps an option. Here's what I was thinking. You've got this black curve represents the probability distribution of a stock that has a low volatility. Okay, we're going to assume that the stock returns have a normal distribution. And this green one is the other stock that has a high volatility. Now, the red line is the payoff to the options, to the call, I mean. The black curve, you can see, has less area above the strike price. Well, actually, it's evenly split between the two. The key detail here is that the green curve moves further into the money, or can move further into the money than the black curve. It can also move further out of the money than the black curve, but because our losses are capped at zero, or our payoffs are capped at zero, when we're out of the money, anything that increases the likelihood of being deeply in the money is going to be helpful. And that something is typically volatility. All right, so I don't know if that helped or not, but the idea here is that high volatility stocks give us a higher probability of a very high payoff, but remember, the maximum we can always lose is how much we paid for the option. So since there's an imbalance between potential profits and losses, anything that increases the probability of both a profit or a loss is going to be on balance helpful to the owner of the option. All right, let's see. Okay, here we go. The upper and the lower bounds for option prices. So again, these are determined through no arbitrage relationships. And remember, we've already seen that arbitrage takes place when it becomes possible to buy an underpriced asset and sell an overpriced asset without taking any risks and by using borrowed money. In other words, this is completely risk-free. Nothing comes out of your pocket, and yet somehow you're earning a positive inflow in the future. This can only happen if markets are inefficient, in the sense that something is overvalued and something is undervalued. Okay, so what about a call option? Oh, by the way, here we have to be careful. Some of these relationships are different for American options and European options. So we'll try to adopt the following convention. A lowercase letter means a European option, and an uppercase letter means an American option. So the first thing we note is that a call can never be worth more than the stock on which it's written. So in other words, imagine an option on Apple stock. It could, if the stock price for Apple is 160, then the call price can never go beyond that point, because you can never have a case where the right to buy a stock is more valuable than the stock itself. Now, that might seem like common sense. And by the way, if you notice, we've got these less than or equal to's. Whatever happens, the European option is always worth either the same or less than an American option, because it has more privileges than the European option. But they could be equal to each other. And sometimes they are, and we'll see when that happens. And then here we're seeing that the stock price has to at least be worth as much as the call, the American call. All right, so what happens on the other hand if this is not true? This is how we can always demonstrate these relationships. Just by showing what would happen in the market if the relationship was violated. If C is greater than S, the American call is worth more than the stock. The call is overpriced. The stock, oh, there's a mistake here. That should say underpriced. Oh, hold on. That's better. Yes, much better. So therefore, because the stock is underpriced, we're going to buy the stock. And the call is overpriced, we're going to sell or write the call. So how does that help us? So we now have a portfolio worth S minus C. Why S minus C? Because we own the stock and we're short the call. Okay, now keep in mind that we are assuming that the call price is higher than the stock price. So therefore, when you do this, okay, so let's quickly remind ourselves. Yes, it's a positive cash flow. So let's just throw some numbers in here. Suppose we have the call is worth 10 and the stock is only worth 9. So our strategy is to buy the stock for $9, sell the call for 10. The difference is the dollar. That goes into our pocket right now. Now, some arbitrages work like this. In some cases, the arbitrage means you collect money today and you have no more cash flows in the future. This is going to be, looks like it's going to be one of those cases. So imagine now we own the stock and we sold the call, or the writer of the call. The payoff to the stock is simply S, but the payoff to the short call option is negative max S minus X and 0, as we saw last time. Okay, so we have two payoffs here. The payoff to the written call option and the payoff to the stock, which we own. All right, so let's consider the two possible cases. Case 1, S is greater than X, which means the call is exercised. So we have S. Now here is the payoff to the writer of the call option. And what this means then is that we have collected X dollars from this. How do you know that? Because we own the stock, and when the call is exercised, we deliver the stock to the buyer for X dollars. So when the call is exercised, we end up with the strike price in our pocket. In other words, X dollars. If the call is not exercised, then we simply keep the stock, which is worth a positive amount. Oops, call is not exercised. So either way, we collected $1 or some amount, some positive amount today, depending on the actual numbers. But no matter what happens to the stock price, we're going to have an asset in our possession which has a positive value. So we're collecting money now and we're collecting money in the future. That is very unusual with an arbitrage. This is a very nice arbitrage. It means we're making money at both ends, in the beginning and at the end. And this is all risk-free because it doesn't matter what happens to the stock, we're going to make money. And no money comes out of our pockets either. So that's what we mean by an arbitrage. Okay, now what about a put? Is there an upper bound for put? Yes, the upper bound for put is the strike price of the call, or sorry, the put. And once again, you notice from left to right, the European put is worth less than or equal to the American put, which in turn is worth less than or equal to the strike price. And of course, as usual, in order to prove this, what you're going to do is show what would happen if the put price exceeds the strike price, and show what kind of arbitrage opportunities are available. All right, so let's say that that happens. Now, this one is a little bit more complicated, but if the put price rises above the strike price, here's what you do. You start by writing the put because the put is overpriced. I guess you could think of X as being undervalued, but it's hard to think of it that way because it's a strike price. But if the put is overvalued, you're going to sell it. And you're going to use the money to buy a zero coupon bond. Okay, but we're going to do this in a very special way. We're going to pick a treasury bill whose price is guaranteed to equal X dollars on the date that the option matures. So what does that have to do with anything? Okay, well, first things first, we clearly collect you're basically selling P and buying X. The difference is P minus X, which is assumed to be positive. That's coming into our pockets today. Now, we have to prove that in the future, we're not going to have any negative cash flows. So let's consider the two possibilities. The put finishes in the money or out of the money. So in the first case, if the option is exercised, remember, we own the put. Oh, actually, wait, no, hold on a second. No, sorry, we sold the put. So because we sold the put, we are the sellers of the put. The payoff is negative max X minus S and 0, but we do get to keep X. Because remember, we invested the proceeds in a treasury bill that is guaranteed to be worth X dollars on the maturity date of the put. So this is our payoff. Now the payoff here, because S is below X, the payoff will be negative X minus S plus S. And that means that the two S's cancel out. Oh, no, they don't, because this is negative. Ooh, so you've got negative X plus 2S, which is guaranteed to be equal to 0. Or positive, I'm sorry, positive. On the other hand, if we do not exercise the option, then we simply keep X, the treasury bill, which is also guaranteed to be positive. So the whole idea here is that we collected money initially, and then later on, no matter what happens in the market, we collect money, whether the option finishes in the money or not. Okay, so let's just recap that. Just so we don't forget. For the call is bounded by the price of the stock. That's as high as it can go. And for the put, the limit was right here. Okay, Now, by the way, we don't actually need a lower bound because it would just be 0. I mean, we can put it in here. You would just put that C is greater than or equal to oh, I need the symbol for that. Hold on. All right, now, rather than spending all night, I'm going to show you a special trick here. Rather than spending all night looking for it, watch what I'm going to do. I'm going to go to Google and say, listen, Google. And it comes back, oh, you mean 2265, huh? Why does that help me? Because watch what I can do now. I can type in that code and voila, there's my greater than or equal to. See, character code, Unicode hex. Each one of these symbols is associated with a numerical value. And so therefore, I can find it without spending all night looking for it. All right. So far, so good. Now, of course, a lot of the bounds that we're interested in may not be, well, these are very broad upper and lower bounds. In many cases, it helps us to understand other types of bounds. But all right, we'll get to those in a bit. Now, suppose that we decide that we're interested in an upper bound, not for the American put, but for the European put only. It turns out that for the just the European put, the upper bound is actually the present value of X, not X itself. The American option is bounded here, but the European option has a slightly lower bound. And so that XE minus RT is what we mean by the present value of X. Okay, and of course, we're assuming here that R is a continuously compounded rate of interest. That's why this works. Okay, so why is that? Once again, what we can do is say, well, listen, what happens if P is greater than XE to the minus RT? And by the way, this can be thought of as the price today of a treasury bill that will be worth X dollars at time T. So in other words, this is what you would pay to buy that treasury bill now and guarantee yourself X dollars at time T, which is when the put option matures. So because the right-hand side is lower than the left-hand side, that means we're going to sell whatever this is, and we're going to buy this. So when we sell a put, we're writing the put, And the payoff will therefore be negative max x minus s in 0. And then using the money we collect to buy this treasury bill. Now, we're guaranteed that right now, this will put money in our pockets. Why? Because we sold something that was too expensive and we bought something that was too cheap. So right off the bat, we're going to collect some money. Okay. The question is, what happens in the maturity date? All right, let me just sneak this in here. So we have P write P by the treasury bill so we know that this generates this amount today, which is assumed to be positive, and then at maturity, one of two things can happen. The strike price, the put finishes out of the money, and therefore, the put that we wrote expires worthless. We collect X. That's the treasury bill. And that X has a positive value. So we're in good shape. On the other hand, if this option finishes in the money, so we still collect X, but pay X minus S, because that belongs to the buyer of the put. Okay, so therefore, the total is X minus S equals S, which is positive because it's a stock, of course. So in other words, we've just shown that we collect money initially, and then at maturity, no matter what happens to the stock price, we're going to make more money. So again, this is a pretty sweet setup. And that's why it's called an arbitrage. It's a risk-free situation that we put ourselves in by buying something that's undervalued and selling something that's overvalued in such a way that we collect money now, and then at the very worst, we have no cash flows in the future. At best, we'll have more positive cash flows in the future. So anyway, are there any more of these? Why, yes, there are. The call, European calls, remember before, we said that, oh, by the way, I just realized this is our first lower bound. Now, the lower bound technically is 0, but this is a lower bound which is worth more than 0. So in other words, this is a very loose bound. In other words, it just says, oh, it has to be greater than 0. But we can make it even more specific than this. We can prove that a European call option always has to be worth a minimum of this amount. Okay, so let's find out why. Now, yes, obviously, and of course, that's going to be, we're going to see that that's guaranteed to be positive. Anyway, so now this is an interesting case. We're going to set up 2 portfolios in order to prove that this is in fact the lower bound of a European call option. First portfolio consists of a European call and a treasury bill or 0 coupon bond that is worth X e to the minus RT dollars today, and will be worth X dollars at the maturity date of these options. The second is simply a share of the stock. Now, what are we going to do with this information? We're going to show that by setting up this portfolio, these portfolios, all right, well, let's see what happens. Let's just set up the portfolios. Now, the first one, this is portfolio A, where we bought a call and a treasury bill. Portfolio B is the stock. Therefore, if you look at the two scenarios, this first one means the call is in the money. And the second scenario means it's out of the money or at the money. When the call is in the money, there'll be a payoff of S minus X. Now, by the way, that lowercase t means, or that subscript t means that this is true on the maturity date of the options. Not today, but on the maturity date of the options. The payoff at that time will be S minus X, plus we own a treasury bill. So that means our portfolio will be worth ST dollars. In other words, it would be the equivalent of simply owning a share of the stock. Portfolio B, you literally do own a share of the stock, so that's worth ST. In the second scenario, the call finishes out of the money, which means that you're just going to end up with your treasury bill. Down here, we only own the stock, so of course we have to end up with ST. Now, in the second scenario, though, remember, we're assuming that, oh crap, sorry. Trying to clean this up a little bit. Now you might say, well, in the first scenario, it's pretty cut and dried that both portfolios have the same value. But in the second scenario, the question is, which one is more valuable? Well, in scenario number 2, you can see we're assuming that ST is less than X. So let's add another row here, just so we can keep a track of this. So in the first scenario, both portfolios are worth the same. In the second case, because we're assuming that X is greater than ST, portfolio A is worth more than B. So what it's saying to us is that in some cases, A and B are equal. So in other words, when S is greater than X, both portfolios have the same value. When this is not the case, portfolio A is worth more than portfolio B. Therefore, it must be true that A is worth at least as much as B. Okay, but remember what A and B represent. A represents this portfolio. And B, hold on. Is equal to S. And therefore, algebraically, this just brings us back to where we started. subtract this from both sides. And this is what we end up with. So this is what we set out to prove. And so you notice how with option pricing theory, we often prove results by setting up portfolios that demonstrate what would happen if there's an arbitrage. And so here, the idea here is that, and I'll just mention this right now. If two portfolios, let's say if portfolio A and B have the same future cash flows and the same, well, presumably the same level of risk, then they must sell for the same price today. Otherwise, arbitrage will result. The cheaper portfolio will be purchased, and the more expensive portfolio will be sold. Okay, and that's how you get the process started. This provides cash inflows today and non-negative future cash flows, meaning that you might get more money in the future, or at the worst, you'll get nothing. So this enables us to derive a lot of very useful results. And we can add one more result to this. Because the European call is worth at least S minus XE to the minus RT, that guarantees that the American call is worth at least that much as well. So we've described here then two lower bounds, one for the American call and one for the European call. And of course, they're both the same thing. Now, let me show you with a graph. Why is this the case? I mean, what is it? How can you see this on a graph? All right, let's find out. Let's see. Basically, you might recall that when we drew these diagrams for the payoffs for the call, we ended up with this. Well, actually, here I don't need the max, because if we're in positive territory here, that's the payoff. But the market price of this option is guaranteed to not go past this point. Let me change that to green so we can really see it. So there's the diagram. This green line is the market price. And it means, you notice how it's getting very close to this lower bound, but never quite touches it. But what's not going to happen is the green line will never move into this territory in here. Because otherwise there would be an arbitrage, as we just saw. So in other words, it basically restricts the prices of these options to within these bounds at least. So at least we know that if we were a trader, for example, and we saw the call price drop below S minus X, we would know that it's time to jump in and take advantage of the arbitrage opportunity that we've been presented. All right, now there's so many more of these, but there's some interesting results that I think we should look. We don't have to go through every single one of these and prove them. I just want to show you some of the other more interesting ones. For example, what about the put? Is there a lower bound for that one. There is. Oh, before we do that, I want to show you one of the more interesting results in option pricing theory. And it's surprising as could be. We know that an American option is worth, American call is worth at least as much as a European call, and probably more. But because of the early exercise feature. In other words, you don't have to wait to the maturity date. But now here's the bizarre part. If an American call is written on an asset that provides no income to the owner, such as a stock that pays no dividends, we can show with the same techniques we were just using that it will never make sense to exercise the American call prior to the maturity date. So that we're going to need to do, we're going to do that in a second using the same arguments that we've been using up to this point. We're going to create some no arbitrage portfolios. But what that implies is this. Because of this, the price of an American call on an asset that does not provide any income will equal the price of a European call on the same asset. Now, that's one of the things that surprised me more than anything else when I started learning about this stuff, that when the asset itself, let's say it's, again, a non-dividend paying stock, it turns out that having an American option on that stock isn't any more valuable than having a European option, a European call, I should say. It has to be a call, by the way. This does not work for puts. So the American call and the European call have the same value in this case, because we can prove that it will never make sense to exercise that American call prior to the maturity date. Well, how come? That's a very strange result. All right, well, let's see why. Well, first of all, we've already seen that for the European, now let's go back and grab that example we were just working with. Let me just go grab it. No, here it is. So you just got through showing this relationship has to hold to avoid arbitrage. And that implies this condition. Okay. Let's see. And now that in turn implies this. All right. This is very annoying with PowerPoint. The fonts are really a pain to work with. Word is very simple. All right. Okay, now, what are we doing here? So I just want to point out that as long as, this is part of the result here, as long as we have positive interest rates, xe to the minus rt is a smaller number than x, which implies that s minus xe to the minus rt is greater than s minus x. And you notice how it's strictly greater than. Okay, not greater than or equal to. Now, remember, now what is this all about? This is the important part. This is the so-called intrinsic value of the option or payoff. This is the minimum value of a European call option, as we've already seen. Now, you notice how X is being discounted here. Now, we already demonstrated this is true. And what I would also like to do is remind you very quickly about an important concept, which we probably already talked about, which is the option's time value. So in other words, if you were to draw a graph of the payoff to an option and its market price, let's say this is the payoff right here. The market price is never going to reach that line until the actual maturity date. Anytime before that, we have the market price and the vertical distance between those two has a special name in option pricing theory. Let's say this is the current stock price. This is the payoff. And this, our intrinsic value, this is the actual market price. Right here. This is the time value of the option. The difference between the payoff and the market price is the time value. And this reflects the possibility that the option will become more valuable. So that's how you can see. We saw with the Apple stock, let's say, for example, the stock we're looking at is $100, the strike is 80, and we discover that the call price is 22. Well, that means the payoff, if we could exercise it today, would be 20, but the call price is 22. So therefore, the time value must be $2. So here's the rub against American options like this. If we exercise it right now, we're going to collect $20. But we could have sold this option to somebody else in the marketplace for 22. And that means we're losing all of the time value. Okay, so in other words, it wouldn't make any sense for us to sell that, to exercise it and collect 20 when it's currently worth $22. We'd be better off simply selling it to somebody else. And this is going to be true every day until the option expires. The market price, as we've seen, will have to exceed the payoff. In fact, we've already seen that we have this other boundary that it can't fall below, which is S minus XE to the minus RT. So we know it's always going to be worth at least as much, if not more, than the payoff until that maturity date. So therefore, it will never make sense to exercise this option. Instead, we would always be better off selling it. And that means that we're never going to exercise it. And therefore, it is worth no more than an European call. Now, if the stock in this case had a dividend, that could potentially change everything, though. Because here's why. Suppose that the stock does have a dividend. Then the owner of the American call might benefit from exercising the call option early and collecting the dividend. Because then suddenly you have the right to collect the dividend because you own the stock. Therefore, the American call could be exercised early and is therefore more valuable than the European call. So the existence of a cash flow like a dividend does mean that you might make more money by exercising the call rather than selling it to somebody else. But if there's no dividend or any other cash flow, then no matter what's going on in the market, you're always going to be better off hanging on to the option, or at the very least selling it to somebody else, because you'll collect the time value, which will not happen if you exercise early. So that's in a nutshell why the American options will not be, the American calls will not be exercised early, as long as the underlying asset provides no dividends. If they do, that changes everything. Then the American call is suddenly worth more than the European call. Now, I did mention earlier, but for puts, no matter what happens, I'll just mention that right here. Oh, here it is. With puts, it doesn't matter if the underlying asset has cash flows or not. The American put, there's always a chance that it might be exercised early. And so therefore, the American put is going to be worth more than the European put. Now, why would that be? Let me just show you a quick case why that might be the case, why you might want to do that. First, let me draw a picture and just remind you what this looks like. Let's see. This is your payoff. And for the American option, at least, let's say this is the market price. Now, what happens here is this. Yeah, let's do that in black. This is why you might exercise the put early. By the way, I do want to point out, and actually I almost forgot why I drew this graph. When you see a case like this, when we're very deeply in the money down here, you'll notice the time value is very low. So what does that have to do with anything? Well, think about this. So with an American put, that is deeply in the money, the time value is very low. Now remember, with the put, you're selling. You're not buying, you're selling. Therefore, it could be the case that if the put could be exercised and the proceeds invested at a relatively high rate of interest, the value of this interest could exceed the time value that is sacrificed by exercising the option. So in other words, it's possible that you can make yourself better off by exercising early. In spite of the fact that you're losing the time value, you're gaining interest. When you sell your stock, you can put that money in the bank. And if the rate of interest is high enough, you might be better off doing that than simply holding on to the put until the maturity date. So therefore, it is possible, it is always possible that it would make sense to exercise an American put early, regardless of whether the underlying asset provides any cash flows. Okay, so therefore, an American put is always worth more than a European put. Okay, that's where the two are not the same. Obviously, so remember, let me just summarize this somewhere here. Summary. So we can keep track of all of this. An American call on an asset that provides no cash flows will never be exercised early. Okay, its value will therefore match a European call. An American put may be exercised early, regardless of the asset. Therefore, an American put is worth more than a European put. All right, so there you go. All right. Okay, so now we know why. Now, by the way, I want to show you, let's see, hold on one second. Oh, now look what I've done here. I very helpfully put together a nice little table. I didn't remember doing this, which keeps track of all of the upper and lower bounds. Look at that. Are you impressed? I like this. So therefore, you don't have to memorize anything. You've got this helpful little chart. And don't forget, lowercase c is European and capital C is American. And with the puts, the same thing. So we've got all of the relationships right here in front of us, and we also understand why. We can show an arbitrage argument that explains why this is happening. Now, I do want to point out, though, that if we're looking at, let's say, options on stocks that provide dividends, we have to adjust these boundaries because, as we know, the payment of a dividend lowers the value of the stock. All right, so this chart means or is assuming no cash flows from the asset, meaning non-dividend paying stocks or other assets with no cash flows. All right, I should probably put that up here in the top somewhere. Maybe it's not worth it. I can probably sneak it up there somewhere. Okay. Now, if there's a dividend, now remember these D's are the present values of all dividends that we will receive during the lifetime of the option. And you can see that we've introduced it here. For the most part, with the calls, we subtract the dividend because remember that lowers the price. And with the puts, we add the dividend because that raises the price. So if we have dividends, then this is what happens to the upper and lower boundaries. All right, now what's coming up next is a bunch of graphs. And then we're going to introduce that amazing put call parity condition, which is based very heavily on all these results that we've just derived. And it proves to be one of the most important results in option pricing theory. Now, let me just take a quick peek at something here. It looks like next week we're going to dive into the actual pricing. Today, we're really just setting up the background. I'll tell you what, though, there's a chance that we might finish a little bit early, and this next week's material is quite long. So I'll tell you what we might have to do. If we finish these slides a little early, I'd like to at least take a peek at session 6 notes because, like I said, it's a very long chapter, and it's based on what we're doing here anyway. So why don't we do this? Let's have our break. And when we get back, we'll look at some graphs. We'll look at the put call parity condition, and then we'll at least take a peek at this week 6 session where we're actually developing models for coming up with numerical prices for these options. But keep in mind, these pricing models are also based on no arbitrage principles. So that's why this proves to be so important, these upper and lower bounds, and the way we prove them with no arbitrage arguments. These pricing models were derived in exactly the same way. Okay. All right, so why don't we stop here and we'll carry on with 5, and then we'll maybe spill over into 6 a little bit just to get the ball rolling for next week. Okay. All right, so let's do it. Ah, all right, let's get back to it. So the graphs, now we've already started to look at some of the graphs, so there may not be a whole lot of new material here, but I just wanted to show you like some of these, like we saw earlier, the red line represents the payoff to a call option, and the black line is the market price. So the vertical distance between them is what we mean by the time value, or the difference between how much you're paying for this option and how much it would be worth if you exercised it. And remember, the market price, the time value reflects the chance that the option will become more valuable in the future. Now, we actually saw some of that before when we were looking at Apple options. I did show you that, for example, when we were looking at the options that mature this week, they were a lot cheaper. That, remember, we looked at the example of the 150 call option on Apple. The one that matures on Friday is only worth $10.90. But when we looked out into January, that price goes up to about, I think it was 13 something. Yeah, there it is, 13.30. So from 10.90 to 13.30. So the longer the time that we allow until the maturity date, the more valuable the option will be, because there's a greater chance that it will become more valuable in the future. Now, let me just quickly show you what that would look like. You have to imagine that we've got, over time, we have several different market prices. So let's start with the payoff profile. Making a mess of it already. No, that's not going to do. Let's try that again. All right, one more time. No, I know why I was using red with this. All right, it's so hard to see it. So this is the payoff. And what all I wanted you to see is that the payoff is fixed. It is what it is. But as far as the market prices are concerned, what's going to happen? Let's say that this curve here represents 6 months until the maturity date. This one represents 3 months. And then the red one is, of course, the payoff or intrinsic value. So what that means is the curves further to the left have longer maturity dates. And as time elapses, they gradually move over to and coincide with this payoff line. So clearly the time value is higher for, let's say, I don't know, like for this one, for example, let's say the market price for 3 months is 10 and the market price for 6 months is 20. So that just shows us that the time value increases as the time to maturity or expiration increases. All right, so that's an important detail. All right, anyway, so when we start pricing these, you'll see how important that turns out to be. Now, here's the graphs this is the American put that we saw earlier, and you can see again, we can easily calculate the time value. The red line is the payoff, the black line is the market price. The red here is the payoff or intrinsic value. They both mean the same thing. By the way, the words intrinsic means it's the minimum price at which the option can sell for in the market without there being an arbitrage. All right, so let's take a little detour here. This is an important detail. The intrinsic value or payoff of an option is the minimum price at which the option can sell in the market to avoid arbitrage opportunities. Yeah, so like, let's say, for example, you know, we don't want to get too deeply into this, but let's just say that we have an option on Apple stock has a strike price of 100. Okay, so if Apple stock is selling for 160, let's say, then the intrinsic value is, and it's just the maximum of S minus X and 0, $60. Okay. If the market price falls below $60, then investors would earn arbitrage profits by buying the call and selling the stock. All right, let's just say that, just to put a numerical example to this, let's say it sells for 158. Suppose that the price of this option is only 158. The investor can pay 158 for the option, exercise it, buy the stock Oh, sorry. Wait. No, I goofed it up somewhere along here. Not 158, 58. Okay. The price of this option, remember the strike is 100. Okay, so let's say instead of 60, it's only 58. The investor pays 58 for the call, exercise it, buy the stock for $100, and then sell it at the market price of 160. Okay, so the investor will earn, now they collect 160, but they paid 100 for the stock with the option, and they also paid $58 for the call option. And guess what? There's your $2 arbitrage profit. Okay, so we just made a risk-free profit of $2 because we were able to buy the option too cheaply. We immediately exercise it. We buy the stock for 100, and we immediately sell it in the market for the price of 160. And that puts $2 extra in our pocket. And that is an arbitrage. And it results because this happened because the call option was too cheap relative to the stock. So therefore, you buy the call and you sell the stock. So this means that anytime this option price falls below the intrinsic value, there's going to be an arbitrage opportunity. Now, you know what this means then? As investors buy the call, the price rises to a more, let's say, realistic level, like 61 or something. So in other words, this won't last for long because everyone will jump on the bandwagon. They'll start buying this option for $58. And before you know it, the price will jump up to at least 60 and probably more than that. So anytime there's an arbitrage, people will, I mean, traders on Wall Street will notice it right away and they'll start jumping in, and their actions, their buying and selling activity will force these prices back to their correct levels. Now, in practice, what's happening here is that it's not so much individual traders anymore in this day and age. It's hedge funds who've set up computers, massive computers, to continuously scan prices and look for these opportunities. And when they're discovered, to actually jump in and execute these trades. So it's getting to the point where human beings can't really do this anymore. It has to be done by computers. And in fact, many hedge funds are set up to do exactly this. They're called statistical arbitrage funds. And they're looking everywhere for these opportunities. And sometimes they actually find them. Because even in this day and age, markets are not 100% efficient. So therefore, there's still money to be made with arbitrage, but only if you have the computer power to do it. Because these opportunities might last for like fractions of a second at most. So the computer is the only one that can be fast enough to execute these trades in time to make money. But because of all this, that means markets are more efficient than ever. If it requires computers massive amounts of time to look for these opportunities, that tells us that this doesn't happen very often, which means markets are more efficient than ever before, which is very reassuring, I think. All right, so what I'd like to do now is show you finally at long last this amazing put-call parity condition. Now, this put-call parity condition only applies for European options. The original version of this was intended to price calls and puts on a non-dividend paying stock, although later on that was relaxed. And it turns out that this is a no arbitrage relationship, which means if it is violated in the market, then somebody will be able to make arbitrage profits. And we can prove this using the same technique that we did earlier. So how does this thing work? We're going to set up two portfolios. We already know that if we have two portfolios that are guaranteed to have the same cash flows in the future, but they're and the same level of risk, their prices must be the same today. Otherwise, arbitrage would result. So, like, let me just think of, I mean, a very silly example of this. It would be like, imagine if one portfolio consisted of a dollar bill and the other one consisted of 100 pennies. If you could buy one more cheaply than the other, that's exactly what you would do. You would buy the cheaper one and sell the more expensive one and put the difference in your pocket. And something like that is happening here. The question is, what belongs in each portfolio? So we'll start out with a portfolio that contains a European put and one share of the stock on which it is written. Okay, so in other words, the put is written on that stock. And we have a second portfolio with a call on the same stock with the same strike price. That's important. This put and this call are written on the same stock, same strike price, same maturity date. So they're identical, except for the fact that one is a call and one is a put. And then finally, we have a treasury bill designed intentionally to ensure that it will be worth X dollars on the maturity date of the two options. So in other words, what we're doing is we're looking for a treasury bill that will expire at the same time as the call and the put and will be worth the strike price of the two. So let's say both the call and the put have a strike of 1,000. You don't see that in practice, but let's say it's 1,000. So what we need is a treasury bill with a face value of $1,000 that matures at the same time as the call and the put. Okay, so it's important that all of these cash flows occur at the same time. That's why the options have to have the same maturity date as does the treasury bill. The call and the put also have to have the same strike price because otherwise we're mixing apples and oranges. All right, and of course they all have to be written on the same stock. All right, so let's see what these portfolios look like. All right, so let's say that The portfolio that consists of the stock and the put is portfolio A. The portfolio that consists, oh, let me write this in here. Down here we have the call and the T-bill. And the maturity date for all of these is capital T. Now, we've got two scenarios, as we've seen before. On the maturity date of these two options and the Treasury bill, there's only two possibilities. The stock price is above the strike or it is not. So what happens to portfolio A in the first scenario? The stock, and by the way, in each of the four cases, we'll still have the stock no matter what. Oh, sorry, in the first two, because the second one, in portfolio B, we do not own the stock. So in scenario one, portfolio A is worth ST dollars because the put expires worthless. So we just have the stock. On the other hand, the call is exercised to provide a payoff of ST minus X. The Treasury bill is worth X dollars. So we end up with exactly ST again. So in the second scenario, we have the stock. We also have the put, which is exercised to provide a payoff of X minus ST. And look what we have. We have a portfolio worth X dollars. And in portfolio B, the call expires worthless. So we end up again with X dollars. So here's the important detail. No matter which scenario we see here, which one occurs, both portfolios are worth the same. That's the key to the whole thing. Portfolio A in the first scenario is worth ST, as is portfolio B. In the second scenario, they're both worth X. So we've satisfied the requirement that both portfolios have the same cash flows in the future. And that means that the price of buying portfolio A today and portfolio B must be equal to avoid an arbitrage. All right. So that's the bottom line. And if that's true, then the cost of setting them up is the same. In other words, remember, the first portfolio is the stock and the put. The second portfolio is the call and the Treasury bill. Now, we typically rearrange this algebraically to come up with this very important result. C equals, no, actually, sorry, P. Hold on one second. We usually express it as P equals C plus X e to the minus RT minus S. Now, what is this telling me? It means that if I know the price of a European call with strike price X, maturity date T, and asset S, I also know the value of this T-bill and the stock. I can figure out the value of the equivalent European put with the same features. Why does this matter, by the way? We're going to see why in the next chapter, but let me just tell you briefly why. I'll just write same, I'm running out of space, same features. Because the Black-Scholes model, which we'll introduce in chapter 6, which was only meant for European call options, can be extended to price European puts because of this put-call parity condition. So in other words, they did not need to separately develop a model for puts because instead they could price calls with the Black-Scholes model and then use those to come up with the appropriate price for puts. So that's why this proved to be so valuable, because this way it saves us from having to develop a separate model for puts. And we can see that it must work, because if not, investors will engage in arbitrage. The prices will adjust until they match up with what we're seeing here. All right. Well, that was interesting. But in other words, this whole idea of having an arbitrage portfolio, by the way, I've mentioned here in the slides, what happens if the left and the right have different values? The details are here if you want to look at them later on. We don't have to go through everything right now, but obviously you're going to sell the side that is more expensive and you're going to buy the side that is cheaper, and you can lock in guaranteed profit today, but your future cash flows will be zero. That's what's happening here. We can lock in a cash flow today, but we are guaranteed also that our future cash flows will be zero, because the cash flows from the two portfolios, if we buy one and sell the other, will exactly offset each other. Okay, so this is still an arbitrage, and these are the details. And same thing here. This time we're buying the left and selling the right-hand side. We're guaranteed that we'll have a profit today, and therefore the future cash flows will be zero. Therefore, this is an arbitrage. All right, now what about cases where instead of having calls and puts written on non-dividend paying stocks, what if the stock does pay dividends? Then we have to make some slight adjustments. So this is what this thing would look like if there's a dividend. We have to take it into account because it obviously increases the value of the put and reduces the value of the call. So in this case, and by the way, it's written this way because this would become this is your portfolio A. And this would be your new portfolio B. Basically, what you'd be doing is buying a treasury that incorporates the value of this dividend. And so you can rearrange it. And again, I've set up the table just to prove that this is true. But the bottom line is this is what this is what it looks like. Or P equals C plus the present value of that dividend minus S. So this is the new piece. When there's a dividend, this is where it shows up in the put call parity condition. Now, this is only for stocks that pay dividends. You know that stocks pay dividends on an irregular basis. Typically, a corporation makes dividend payments 4 times a year, or at least 4 times a year, the board of directors gets together and votes on dividends. That's why it's written this way. But it turns out that for options on other types of assets, let me just sneak this in here now. There are options, many options, written on assets that provide cash flows that are paid out on a regular basis. For example, here's an example. And by the way, I do want to mention here that actually, let me put this in here first. Note, cash flows from a bank account are assumed to be compounded daily, which is very close to continuous compounding. Therefore, an option on a foreign currency, such as the British pound, could be considered an option on an asset on an asset that pays a continuous compounded return or yield. So in other words, in cases like this, where the cash flows are being paid out essentially on a continuous basis, we can use another version of the Pocoll parity condition to account for this. And it turns out that most assets in the marketplace are actually better suited for this type of model rather than the one with the discrete dividends. This is really unique to the stocks that pay a dividend because these dividends are paid out so infrequently. Many other assets provide cash flows that are being compounded very frequently or possibly continuously. So therefore, in these cases, where assets with a continuous yield, as it's called, or return, there is another Pocoll parity condition that we use. And I'm going to show it to you on the next page. And of course, as usual, it can be proven that this is a no arbitrage relationship because we can show what would happen if the relationship is violated. So here, the change is we're going to use this letter Q to represent a continuously compounded yield to asset S, whatever it happens to be. So I've circled the difference between the original Pocoll parity condition and this one. So if you notice, we're actually reducing the value of S by that continuously compounded yield. So to set up the portfolios to prove that this works, what's on the left is portfolio A and what's on the right is portfolio B. And you can go through and look at the table and you can see that, or if we wanted to go that far, that this does in fact give us a no arbitrage relationship. This is the one we're going to use most frequently in section 6. Okay, when we start introducing the Black-Scholes model, we'll use this version of it, of the Pocoll parity condition, to price European puts. Okay, so the Black-Scholes model will be used to price European calls, and then this version of Pocoll parity can be easily used to price the corresponding European puts. All right, so like I said, I mean, that was pretty much it for session 5, but because session 6 notes are so long, I would like to at least show you some of what's coming. And by the way, there's no assignment for this week because these results are so abstract and bizarre that you get a week off from this. This week, you get a week off from assignments, but next week, we're actually going to do all of this in Excel. And you'll see why, because it's easy to organize our material. And also the math is so much easier in Excel than we're trying to use a calculator. So now we're finally ready to actually price options. So we're going to start with the Black-Scholes model, which I think I briefly mentioned it earlier in the course. This model was actually an academic paper that was published in 1973, and it kind of opened up the doors for options trading in the United States because for the first time it became possible for people to understand what options were actually worth. Before that, nobody really knew, and so there's almost no options trading in the United States. This is why they got the Nobel Prize in economics, because it proved to be hugely important. Now, by the way, and I think I also mentioned this, the original Black-Scholes model was only meant to price European calls on non-dividend paying stocks. Now, it became clear pretty quickly that there was going to be a demand for other option pricing models that could price other assets as well. So of the three of them, Merton actually sat down and wrote a series of papers in which he showed how Black-Scholes could be extended to price other kinds of European options. For example, options on currencies and options on gold and options on commodities. If it weren't for Merton, the Black-Scholes model wouldn't have ever been that important because it was only going to be restricted to stock options with no dividends. It was Merton who showed how the model had enough flexibility to be extended to price other kinds of options as well. And that's why it's still being used. Here it is, almost, 50 years later. There's a reason for that. It's popular because it works, and it's really not all that terribly difficult to implement it. Although when you see the formulas, you might disagree. You're going to, once you get into the Excel, you'll see that it really isn't all that difficult. We're also going to use put-call parity so that we can come up with the equivalent put prices. And then, now this is the challenging one, the really challenging part. We're going to see what to do about American options. Okay, now the reason why American options are so much trickier is because we have to consider the possibility of early exercise. And that really complicates everything quite a bit. But we're going to start with Black-Scholes. And so it was introduced in 1973 by actually 3 authors, Fisher Black, Myron Scholes, and Robert Merton. Now, why is Merton's name not on the model? Well, because he came along after Black and Scholes actually had already started working on this model. I guess one day he ran into them and they said, you know, Bob, we're working on this interesting model. Maybe you'd like to be involved with it. And so he was the one who actually provided a lot of the mathematical background that proved to be necessary. But when they were done, when they published the paper, they said, listen, why don't we call it Black-Scholes Merton? And apparently he said, no, don't worry about it. He was very modest and he told them not to call it Black-Scholes Merton. Now, having said that, some textbooks actually do use that name anyway, Black-Scholes and Merton, because he was so important in this project. Now, and like I said, later on, he went on to develop more sophisticated versions of Black-Scholes. And he also eventually he started his own company and he came up with a credit risk model based on option pricing theory, which he sold for a ton of money to Moody's. So Bob is doing well these days. Now, I'm guessing he's retired by now. I mean, really, he can't be that young. Let's see, I'm going to guess that he's got to be in his 80s by now. Hold on. And of course, he did share the Nobel Prize with the others. I mean, the committee knew that he was a major part of this. All right, how old is he? Robert, no, not a sociologist. No, here we go. This Robert Merton. Oh, 77, all right, so he's still not 80 just yet. Yes, and so because of his contributions to this model, he did get the Nobel Prize in 1997. Now, so did Myron Scholes. Now, sadly enough, by the time 1997 rolled around, Fisher Black had already died, so he did not get the Nobel Prize, but Merton and Scholes did get it. And it was because this turned out to be so incredibly important in the world of finance. And so there's Merton. And according to this, he's currently at MIT. I'm not surprised. Man, look at these awards. Ooh. Where does he put them all? His shelf must be bulging with trophies. Man. You know what, while we're at it, why don't we look up the others? So Scholes, he's got to be close to 82. How old is this guy? He is 80, okay. And he and Black, I guess they were consulting with each other on this option pricing model. And I don't know exactly how they got in touch with Merton, but anyway, let's see if we can find Fisher Black. Yeah, he died very young. He died just a couple of years before they got the prize. He was only 57. Oh my God. But yes, he was like a very important. He obviously in Merton started this project, but that's what he was named for or known for. Now, the ironic thing is that I've actually met people. I met one person who was interviewed by Fisher Black and another person who actually had a class with Robert Merton. And they told me that these two guys, being the super geniuses that they are, were incredibly modest, almost shy, about what they'd done. But then I've also heard that Myron Scholes is kind of a jerk, but I mean, I don't know that for a fact. But I've heard things about that. But anyway, these are the three. And so this proved to be like almost as important to finance maybe as relativity as the physics, because it's not just the model itself, it's the foundations that they use to create it. All derivatives pricing models are ultimately based on this framework. So they really and truly revolutionized the field. Now, the model itself, interestingly enough, a lot of the math from this model was borrowed from physics. And so you probably knew that a lot of physicists ultimately end up working on Wall Street because the math that they are taught is very useful in finance as well. Okay, it's not that unusual. It's a very easy path for them to take. And this is one of the reasons why, because it's so easily adaptable to option pricing theory, among other things. And so the model itself was based on several strong assumptions. Oh, by the way, I almost forgot to mention, the paper appeared in the Journal of Political Economy in 1973. It's hard to imagine now, but before it got published by the Journal of Political Economy, it was actually rejected by 8 other journals. Now, imagine themselves to this day thinking, oh my God, we could have published the Black-Scholes paper, but we turned it down. Okay, and so, you never know. I mean, it's just so funny how these things work out. But anyway, what are they assuming this model? Now, these assumptions turn out to be quite important. And most of them are not very accurate. Let's put it that way. So that's going to ultimately prove to be a problem. Now, later on, a lot of research was developed to help maybe smooth over the problems with using Black-Scholes. But when it was first introduced, it worked very well. And a lot of these assumptions were actually pretty good. But as time goes on, many of these assumptions became less and less realistic. For example, volatilities are probably higher than they were at that time. And as far as the normal distribution is concerned, returns to stocks are probably not normal, but they're semi-normal in the sense that here you see the black curve is the normal distribution. Red is what we actually see stock returns. And they exhibit what we call fat tails, or in other words, with stocks, we see more extreme outcomes than you would get with the normal distribution. And then on top of that, there's a bias in favor of losses compared to gains, as you can see there, compared to the normal distribution. So it's not a perfect assumption, but it's a pretty good one. It's not that far off that it would ruin the results. So we're in solid ground there. But the volatility assumption is kind of a problem. And so a lot of research has been developed to kind of dance around this a little bit. In other words, remember we talked about volatility before. Volatility refers to how much the stock's price is likely to bounce around, but that itself can change. Like for example, let's say that this is what your stock is doing over time. At first, it's moving along very smoothly. And then suddenly it starts to gyrate all over the place, and then it goes back to being very smooth again. So you've got periods of high volatility alternating with periods of low volatility for the same stock. And this could be caused by a lot of things, like here, maybe there's something going on in the economy. Maybe there was some political intrigue in Washington. Negative external events, we'll call them, cause the volatility of the stock to change, even within the same calendar year. So it can happen. Now, by the way, here's an interesting side note. Talking about derivatives, there's another important breakthrough by an academic, Robert Whaley at Duke, always had this idea. Let me just mention this because this is important for what we're going to do. So Robert Whaley, who taught at Duke, proposed an index based on volatility, which was adopted by, I think it was the Chicago Board Options Exchange. Let me confirm this. It's the CBOE, okay. Chicago Board. Now, remember the first week we talked about how we can buy derivatives on just about anything you can imagine? Well, it turns out investors can buy options and futures on the VIX index, as it's called. Okay. Oh, sorry, I forgot to mention that. The index is called the VIX. Which is really just a way of abbreviating volatility index. That's all it means. There's no special hidden meanings in there. And not only is there such an index, but you can actually buy options and futures on the VIX. This makes it easy to speculate on volatility, just like with butterfly spreads and straddles, which we saw last week. Now, I just want to show you what it looks like. And don't worry, there's a point to all this. So the Fed is the Federal Reserve Economic Database at the St. Louis Fed, and they keep track of all kinds of economic data. And so this is what the VIX index has looked like recently. Now, what do you notice about this thing? It bounces around all over the place. In other words, volatilities over here, they're very stable, and all of a sudden, woo, they spike up. Then they flatten out, and they spike up, they flatten out. Now, this one was clearly caused by the COVID. When there's uncertainty in the market, the volatility index jumps up. When things calm down, the volatility index also calms down. So this is what the VIX looks like, and this shows us that volatility doesn't stay constant over time. Okay, it does bounce around. So the Black-Scholes model is assuming constant volatilities, but it's not maybe as bad an assumption as it sounds, because remember, they're talking about the lifetime of an option, which could be as little as 3 months. So it may be that during the lifetime of an option, the volatility of an asset may very well be constant. But research has shown that even over that short time period, volatilities are typically not constant. So that's probably the weakest assumption of the Black-Scholes model. It has the most impact on the results. Let's put it that way. So that one is kind of a pain, but lots of research has been done to help find ways to work around this problem. They also assume that the risk-free rate of interest, the yield on a treasury bill, is constant during the lifetime of an option. And that's not a terrible assumption. So anyway, this is the actual Black-Scholes formula. Now you're looking at it and saying, what is this all about? Okay, well, we're going to find out next week. But we're going to do everything in Excel. We're not going to try to use calculators. Everything can be done easily in Excel. And in fact, well, I'm going to send you the stuff tonight for next week, and you'll see that I've put together several really nice spreadsheets that are designed to make a lot of this simpler for us. Okay, so I just want to mention that. Now, so like I said, for this week, we're not going to have any assignments because the material is very abstract. But next week, we'll have assignments based on these Black-Scholes results. And we're also going to see not just the Black-Scholes model, but the techniques that can be used to price American options. All right, so we're going to have a busy week next week, even more so than usual. But when you're done, you'll have a very thorough understanding of how options are actually priced in the marketplace. And maybe your Excel skills will go up a lot too. There's nothing wrong with that, right? Okay, so I guess we can sort of cut it off right here. We'll come back and revisit this next week. And yeah, you know, when you start looking at this, it looks a lot scarier than it really is. So, you know, just be aware that once we get the formulas into Excel, it's not that hard at all. Okay. So, all right. So if there's no last minute questions, I guess I'll see you all next time. And as soon as we sign off, I'll send you the notes for next week. Okay. Any questions? All right. Well, then have a great week and I'll see you next time.
Thank you.
Okay. Bye.
Thank you.
Okay. See you later.